I want to start with inflation because that obviously surprised to the upside, even though we get those monthly numbers coming through now. Does this make the RBA think twice about, I suppose, in a sense, that the slowing down of the pace of rate hikes?
Yeah, it's an interesting question. I mean, inflation did surprise to the upside in the third quarter. Headline numbers up at 7.3, fastest since 1990. And the core measure, that key trimmed mean, is already running above the RBA's forecast for the end of this year. So that's at 6.1%. Broad-based, we can see pressures from supply chains continuing, strong demand driving prices to ongoing construction costs and labour constraints. So really a lot of inflation everywhere and quite broad-based. I think for the RBA, what's really interesting is, are they regretting a little bit not delivering a 50-point hike at the October meeting? We know they deliberated between 25 and 50. Would it 50 have put them in a better place at the moment and given them a bit more optionality? I think that's the interesting question. But there's no doubt the inflation data and its details tell us we still need further hikes from the bank. They need to move into restrictive territory. So we're going to see a bit more from them at the November meeting. We think it will be 25 basis points and again in December.
Do you think, because a lot of, I suppose, discussion centres around the fact that, the RBA has far more policy meetings than the Fed, and so that also provides them with a little bit of wiggle room when you're talking about the differentials. But if the Fed continues to get aggressive as they have been, and if we do see a terminal rate as the market's pricing just a shade under 5%, can the RBA play this pragmatic game in terms of their own hiking strategy, or is it just going to be forced into a situation where it has to follow along?
Look, there's no doubt the global central banking backdrop is important for the RBA. It does factor into their policy deliberations. But I think what's important is they've been at pains to point out that there are some differences in the Australian economy. Wages growth, while picking up, is clearly not at the types of levels as the US or some other developed countries. So it's probably more in a 3 to 4% pace than 5% plus. And that's quite important, I think, for inflation, particularly core inflation and services going forward. As well, the transmission that comes from hiking here that, is not to the same extent as the US and elsewhere. The transmission really is through the currency, and the RBA, through some of its communication recently, seems to be downplaying the impact of a weaker currency on inflation, noting that in TWI terms in particular, the currency hasn't moved that much. So the RBA seems to be beating to a slightly different drum. I don't think it can be completely different to elsewhere. What's important as well is they're starting to acknowledge some are going to have to do as much as the likes of the Fed and some other central banks. But, it is going to still need to do more, and terminal will still be moving higher.